Hey everyone, and thanks for jumping back into the Macroverse. Today, we're going to talk about the money supply, or M2. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and check out Into the Cryptoverse Premium at intothecryptoverse.com. There's been, of course, a lot of talk about the money supply over the last several years as the Fed printed trillions of dollars back in March of 2020, and now we have been dealing with the consequences of that due to things like inflation for quite some time. We also know that the money supply has been trending down or so for a little over a year, so we want to talk about that a little as well. Now, one of the things you may notice is this is on a linear scale, at least the metric here that we're looking at, the M2 money supply, and of course it has been increasing fairly quickly over the last couple of decades. However, if you were to switch this to a logarithmic scale, you can see that the money supply has been following a fairly well-defined trend and almost a very predictable trend for quite some time. However, there was a deviation from this trend back in March of 2020, and recently you can see we've actually rolled over and the money supply is starting to go back down again. Now, because it's going down, it makes people want to look at things like the percentage change on a year-over-year basis, because this is not something that we've really typically seen. If you look, at least not anytime recently, if you look at the year-over-year percentage change of M2, you can see that it is actually quite negative right now, to the tune of about -4%. Now, this is notable considering, at least on this chart, we don't really see the M2's money supply seeing a drop year over year, going all the way back to the 1960s. I mean, none of the data that we have here going back to the 1960s shows this as being negative. In fact, you'd have to go back, I believe, maybe about 100 years or so to find a time when the money supply was going down like this into sort of negative territory when you look at it year over year. Now, that might sound pretty bad, that the money supply is contracting, and I do think that it is likely going to have some, at least create some macro headwinds for risk assets in general until we start to see some type of shift in this trend. And I mean, of course, it could come before then. But you may notice that, while there's been a lot of talk about where the stock market is and what it's doing, if you really zoom in here, has more or less remained unchanged for about a year now, right? I mean, a year ago we were at these prices. We were also at these prices back in August of 2022. We were at these prices back in February 2023, and we find ourselves again at these prices today. Now, that might seem somewhat optimistic. However, if you were to account for inflation, I mean, in terms of real returns, not nominal, this is still not really great, right? Considering inflation has been so high, and to find yourselves with the S&P is still at the same valuation that it was more than a year ago. Furthermore, it's at the same valuation that it was at back in early 2021 as well, right? So you're talking a couple of years, and the S&P is more or less at a very similar value, despite the fact that we've had record inflation, at least for the last several decades. So that is something to consider. So the year-over-year percentage change, as I said, is down to -4%. Now, what's interesting, though, is if you look at a month-over-month change, you can see that this is actually going negative, going increasingly negative, meaning that while it's true that the money supply is going down, in recent months, it's actually started to go down more quickly than it was before. For instance, if you look at the month-over-month percentage change back in, say, May of 2021, it was about 1.5%. And then in December 2021, it was 1.1%. In July of 2022, 0.168%. In September 2022, negative 0.626%. And today, it's actually a negative 1.22%. So we are not only seeing the money supply contract, but we're seeing it accelerate to the downside, meaning it's contracting even quicker today than it was, say, 6 months ago or 6 months before that. So that is something that I at least think is notable. Now, of course, while I do think it provides a headwind for risk assets until we see some type of shift in this trend, I would also argue that to some degree, we are just simply going back to trend. Again, if you look at this chart, the money supply here on TradingView, and we draw a trend line going all the way back to, say, 1996 through the data, you could argue that we are just simply trying to get this back to trend. And once it gets back to trend, perhaps, we'll sort of resume the normal money printing. But it's hard for us to do that right now with inflation so high. So again, the Fed continues to roll off assets from their balance sheet. Rather, they're reducing the size of the balance sheet. We, of course, are dealing with higher interest rates than we have in a long time. And all of this, of course, will likely continue to put some type of headwind on risk assets. It doesn't mean you won't ever see them go higher. It just means that, we're still likely going to be range bound, and we could, of course, explore lower prices at some point as the months pass on. But when you think about the money supply M2 and simply going back to trend, it's not necessarily, say, the harbinger of doom that you might be tempted to make it out to be, right? I mean, during previous depressions, we saw the money supply go negative. But again, we're dealing with with circumstances here where we saw M2 go significantly off of the prior trend, right? So to some degree, we are just simply trying to get back to trend, right? Where it could become a more significant issue is if it goes below trend, right? Like if the money supply ends up coming like down like this, then that could be a pretty big issue. Doesn't really seem like the most likely outcome, but it is something that we need to be aware of. And if that happens, then I would imagine it would put a lot more downward pressure on risk assets. As it stands today, right? As it stands today, I think it's likely headed back to the general trend. Okay. Now, if it's going back to trend, does that mean that you need to see, you necessarily need to see assets respond in kind? One of the things I've said, again, I think that it will provide a headwind for risk assets until you see this sort of reverse course and go back, or at least, but maybe just before it reverses course and goes back in the other direction. Now, if it goes just simply back to trend, I still think that it's not necessarily the most bullish thing for risk assets, because if risk assets, when the money supply was way up here, we saw them get very, very inflated, and we've since seen a lot of them come down, right? A lot of risk assets have come down significantly. Of course, some have rallied, right? But I mean, bank stocks are getting absolutely annihilated right now. And of course, various sectors are seeing those sort of capitulations at various times. But when you think about going back to trend, it still likely is a headwind, even if we don't overshoot it to the downside, because it basically gets risk assets back to more fair valuations rather than inflated valuations just simply because more money was printed, okay? When you print trillions of dollars, people are going to seek yield on that money. And one of the places that people are going to put it, of course, are in risk assets. So if money is then destroyed and there's not as much money in the system, then I mean, it would make sense to me anyways that it would provide some pressure to those risk assets that at one point it initially supported. So, I think it's always a good idea to sort of look at things as objectively as we can. Of course, I don't always do the best job of that, admittedly, but you sort of see both sides of it, right? I mean, you see some people say, well, money supply year over year is going down, which is not a good thing. And it has only really happened in pretty bad times in the economy. And that's true. And I think there's a reason to be concerned. On the other hand, when you look at it from a glass half full perspective, you could argue that it's going back to trend. And so the main conclusion that I have from this basically is that the money supply going down is likely a headwind for risk assets. The main risk lies with us overshooting this to the downside. Until we see this get back to trend or get to the point where it's going to start moving back in the other direction, I think it's going to remain a headwind. And I just simply don't see that changing until the money supply starts to go back up. Because, as much as we might not want to admit it, when you look at say, the S&P 500 divided by the money supply, you'll in fact notice that we're at valuations that we were at back in the 1990s, right? 1997, we were at the same valuation when accounting for the money supply. Okay, so another sobering reality, if you're still not on board with this idea, is that, and again, this is like a difficult pill for I think some people to swallow, but the valuation we reached in February of 2020, just before the March 2020 capitulation, was the same valuation that we peaked at in late 2021, more or less. Think about that for a minute, right? Think about how crazy that is. Think about how crazy the rally we had in risk assets was in 2021 and 2020 and 2021. Think about how much things went up. When you account for M2, we did not go any higher than, or not much higher than where we were back in early 2020, just before the crash occurred. So when you think about it like that, it really does open up another perspective on the market, right? To some degree, really ever since the 1990s, most risk assets have gone up commensurate with the money supply. Okay? That's just a fact, right? I mean, that's just something we've seen. And so when I think about this chart, and I think, well, if M1, or sorry, if M2, if it going up leads to risk assets going up, and if risk assets are basically trending sideways as a function of M2, then it means that they're very dependent on the money being created. But if money is being destroyed, then that's why I think it provides a headwind for these risk assets, because now you're taking money out of the system, right? You're removing liquidity from the system, and therefore you would expect risk assets to sort of respond in kind. But it is really interesting if you look at this chart, a bit. You'll find things where prior capitulations, right? Like the December 2018 capitulation is very similar to what happened back in September of 2022, and so on and so forth. And also the 2016 capitulation here was not that different than what we saw back over here in at the end of the .com crash. If we were to go back to the lows of the .com era on this chart, I mean, it would still call for another 32 to 33% move to the downside on the S&P divided by the money supply chart. But again, I would encourage you to go look at a lot of risk assets and just simply divide it by M2 to see what story can we, what story is the asset trying to tell? Is it going up because the money supply is going up, or is it going up for other reasons, right? Is it outperforming the pace of money that's actually being created? So think about it like that. And then we can better understand, I think, the money supply chart. We can better understand the implications of a year-over-year percentage change, it's negative, right? And getting us into this contraction territory hasn't really been a great thing, a great indicator in the past. It's not necessarily as bad in terms of just looking at it like this, once you account for the fact that we are likely just going back to trend. Be that as it may, the fact that it's going down should provide some type of headwind for risk assets. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and again, check out Into the Cryptoverse Premium at intothecryptoverse.com. I'll see you guys next time. Bye.